Hello there, I'm Erin Aid. This is Boom Bust, and these are some of the stories that we're tracking for you today. On this special Boxing Day episode of Boom Bust, we're telling you all about Japan's historically low savings rate and the new challenges facing Prime Minister Abe. Plus, Jim Rickards is sharing with us his thoughts on oil and Russia. And in today's Big Deal, Edward Harris and I are looking back at some of the biggest deals of 2014. It all starts right now. Our lead story today, Japan. Inflation in Japan dropped to a 14-month low in the month of November, and policymakers are welcoming this respite brought on by the recent and sharp drop in oil prices. The disinflation comes as a relief to consumers who, since April, have been struggling with an increased consumption tax, which has put a squeeze on many household finances. Now, it was the first consumption tax in 17 years. However, the latest fall in the core consumer price index to 0.7% in November, down from 0.9% in October, will cause some concerns for the central bank, which has staked its credibility on hitting a 2% inflation rate within 2 years. The BOJ still expects to hit its 2% target sometime towards the end of the fiscal year. But in order to get there, it has to depend more on the private sector and aggressive price and wage setting behavior. They need to look to the private sector to set all of that. Now, meanwhile, for the first time on record, Japan's population is drawing down on its savings. This highlights the challenges facing Prime Minister Shinzo Abe as he tries to revive his country's economy, which is the third largest economy in the world. The savings rate in the year from March was minus 1.3%. This is the first negative reading since the Cabinet Office started collecting data back in 1955. Now, in November, real earnings fell 4.3% from a year earlier as Japan's population ages. Now, its growing elderly populace, they're tapping into their savings, and consumers also ran down their savings to make purchases ahead of April's sales tax increase. The savings rate is calculated by dividing savings by the sum of disposable income and pension payments. Back in 1975, it peaked at just over 23%. Some economists are now expecting the DOJ to formally abandon its 2-year time frame and embark on another round of monetary easing in the second half of 2015. To get his take on oil and Russia, I was joined earlier by Jim Rickards. Now, Jim is the chief global strategist at West Shore Funds and author of the best-selling books Currency Wars and The Death of Money. Now, in this segment, I first asked him all about Russia and oil, and here's what he had to say.
I agree completely, and of course, we talked a little bit about that, a few minutes ago about how some of these, Russian corporate bonds could end up in U.S. 401ks, but it's a lot more complicated than that. First of all, it's not all about Russia. I mean, there are a lot of emerging markets that have borrowed in dollars that don't even make as many dollars as Russia. At least Russia has some capacity to earn dollars to pay off dollar debt. They have pretty good reserve position. But I look at places like Turkey, Mexico, South Africa, Brazil. They have enormous U.S. dollar debts, and not clear that the corporations, at least, have the U.S. dollar earnings or access to reserves to pay them off, and so they may go. Some of those companies may go bankrupt. The problem, Aaron, is you're looking at about $9 trillion of U.S. dollar-denominated emerging market debt. $9 trillion. It's not all going to go bankrupt, but let's just say 20% went bankrupt, or even let's just say 20%. That's $1.8 trillion of losses. That's twice as big as subprime in 2007. If you look at subprime plus what they call Alt-A, Alt-A is just a mortgage kind of like subprime. The amount of subprime in Alt-A in mid-2008 was about $1 trillion. Well, if you have $9 trillion of emerging market dollars-denominated debt and you write it off 20%, that's $1.8 trillion of losses. That's 5 times what happened in the mortgage market. I mean, mortgage losses were on 100%. So it's 5 times bigger than what happened in the mortgage market in 08. So there's contagion for you.
Now, a lot of people are talking about the ruble rout as a crisis along the lines of 1998 or 2008. So do you think this is what we're seeing right now, Jim?
Well, I think it's similar in the dynamic, but of course it's never the same in details. There were a lot of differences between Russia today and Russia in 1998. The problem in 1998, Russia had an enormous amount of U.S. dollar-denominated debt, government debt, external debt. And you had banks like Credit Suisse that were out there sort of writing derivatives on it, multiplying it. You know, I'll go back to my experience at long-term capital management. A lot of people say, oh, long-term capital management failed because Russia defaulted. Well, that's not exactly right. We only lost $100 million on Russia. We lost $4 billion overall. The losses at long-term capital management were $4 billion in about 6 weeks. But only $100 million of that, a relatively small portion, was Russian debt. But what happened was the Russian default caused a global liquidity crisis, and that caused everyone to sell everything. So at long-term capital management, we lost money on, you know, German swap spreads, French swap spreads, Japanese swaps. We lost money all over the world. We didn't lose that much on Russia, but Russia was the first domino that started all the other dominoes falling. So now Russia's in a very different position. They do not have as much external dollar debt relative to the reserves. The reserve position is fairly strong, including about $50 billion of gold. Let's not forget that Russia has been a major, major gold buyer, and that gold is a very solid asset on their balance sheet. So there's not going to be a big external sovereign default in Russia. Russia has enough reserves to pay off its sovereign debt. The problem is elsewhere, corporate debt. European banks that may own it, U.S. investors who may own it decide to sell, and then, you know, margin calls coming in. I mean, there's a lot of things that can ripple around the system. So we certainly haven't heard the last of this.
Now, Jim, you've been talking about the U.S. dollar as having problems, but everyone else is talking about a strong dollar, and they say that the strength of the U.S. economy is strengthening the dollar and creating volatility elsewhere. So what's your view?
Well, a couple of things. First of all, the dollar is very strong. It's the strongest it's been in about 8 years, so that's just objective data. There's no question about it. But let's think that through. The Fed says they want inflation. That's not me making it up. The Fed has said they have a 2% inflation target. In fact, in December 2012, they said they were not going to raise rates until not before a forward forecast indicated 2.5% inflation. And again, I've spoken to Fed officials privately who have told me they wouldn't mind seeing 3% inflation. So let's just say the Fed has an inflation goal of 2 to 3%. Right now, inflation is about 0, even slightly negative. A strong dollar is deflationary, so it's the exact opposite of what the Fed says they want. So, and the Fed's been sort of hinting that they may raise interest rates in 2015. Well, that makes the dollar even stronger. So now you've got this conundrum. The Fed wants inflation, but they have a strong dollar. They're going to raise rates, make it stronger, which causes deflation. It's the opposite of what they want. So the only way that all makes sense is if the U.S. economy is really strong, but the U.S. economy is much weaker than meets the eye. These, you know, GDP reports, a lot of that was inventory. There was some, you know, Commerce Department failed to make some seasonal adjustments in the third quarter. There's a lot there, a lot of reason to believe that those numbers are going to be revised down, and that the fourth quarter and first quarter of 2015 are going to be a lot weaker. So now the Fed may be in a position where they can't raise rates because the U.S. economy is weak, and then this whole thing may reverse. But for the time being, but by the way, Aaron, Bernanke gave a very important speech in Tokyo in October 2012, and Janet Yellen has echoed this since then. They say, hey, we're the U.S. central bank. Our job is to take care of the U.S. economy. You emerging markets are on your own. Sorry, it doesn't work that way. You know, we're in a globalized world. You can't be globalized on the way up and then somehow separated on the way down. If this strong dollar causes the emerging markets crises of the kind I'm describing, and it does start to resemble 1997, 1998, all these chickens are going to come home to roost back in the U.S., so the Fed's not going to be able to wash their hands of it.
That was Jim Rickards, Chief Global Strategist at West Shore Fund and the author of The Death of Money. Time now for a very quick break, but stick around because when we return, we're going to share with you the best comments from our recent guests in today's Defining Moment segment. And in today's Big Deal, Ed and I are discussing some of the biggest deals of 2014, from falling oil prices to the bond bull market. We'll have the details coming right up. And remember, you can see all segments featured on today's show on YouTube, youtube.com/boombustrt, and on Hulu, hulu.com/boom-bust. Don't go anywhere.
Most people think to stand out in this business, you need to be the first one on top of the story, or the person with the loudest voice, or the biggest ratings. In truth, to stand out in the news business, you just need to ask the right questions and demand the right answers. question more.
Welcome to the future.
Join us this month, regular as clockwork, as Christmas comes early for Russia's brightest and best. We help you out with some gadgety gift ideas, and if you're worried about piling on the pounds this holiday, we've got you covered. Tune in this weekend. Cheers!
Technology update here on RT. We've got the future covered.
With Russia. Joining me in the now is Professor Robert.
Policies.
Consider I'm Peter Lavelle. A pleasure to have you with us here on RT today. I'm Rory Sushik.
Welcome back to the show. Up now is this week's Defining Moments segment. Now, this is a collection of the most interesting comments made by our recent guests. Take a look at what our guests had to say on the subjects of the IBM, no, just IBM, the Federal Reserve in 1920s, emerging markets, Rajan, and U.S. GDP. Enjoy.
IBM is a company that is using vast amounts of incredibly cheap debt to buy back their shares, and so it's emblematic of a phenomenon where investors see PE ratios dropping and they get all excited, and so the per share earnings are going down. I mean, the per share earnings are going up, and everyone says, "Oh, that's fantastic." And then what you don't notice is they're destroying their balance sheet. So the average investor seems, or journalist seems incapable of understanding that as the balance sheet is getting rotted out like some private equity company strip mining it, that's like a stock split. That's a zero-sum game.
The 1920-21 affair was unique in the violence of the move in interest rates. And I think what it illustrates is I think what the entire episode illustrates, Aaron, is the remarkable curative powers of that thing we call the invisible hand, or the price mechanism, Adam Smith's mysterious mechanism by which individuals acting in their own interest make adjustments and thereby organize a society for production. One of the big differences between the present day and that distant day is that then the value of money was meant to be fixed. It was inviolate. $20.67 got you an ounce of gold. You can exchange the dollars and small change for gold, and vice versa. Exchange rates were fixed, and wages and prices were meant to do the adjustment. These days, of course, it's entirely different. Wages and prices are meant to be managed to rise year in and year out, and it is the value of money that is to do the adjusting, and exchange rates that are meant to be adjustable. So it's a very, very different world. That world is a very different world than our own.
The big recipients of the carry trade, where the hot money all went during the lowering artificial manipulation of interest rates down in the United States and Europe and of course Japan, that hot money has flowed out and it went someplace. And one of the big recipients, for example, is Turkey. And Turkey will really see the brunt of it, because Turkey's done very well, by the way, since 2009. And the reason they've done well is that they've just been flooded with hot money, chasing yield. And if that reverses, Turkey will be particularly vulnerable on that count, as well as the fact that the government in Turkey really has not been paying attention to the economy, and they haven't been making hay while the sun's been shining. Let's put it that way. They've been fooling around, trying to expand what is perceived to be the Ottoman Empire's periphery, and so they're all tangled up in, I think, a variety of misguided foreign policy activities, and they haven't been paying attention to their domestic economy. So they'll be clobbered. I think another place that'll probably be clobbered will be Indonesia. And I think also, I mentioned China. I mean, there's been a lot of hot money that's gone into China, and I think this will affect China as that hot money dries up.
It's made a huge difference. When Governor Rajan took office last year, the economy was going through a very difficult period when the currency's value was plunging, inflation was high, foreign investors were taking money out of the country, and growth had come to a halt. He turned things around very quickly by doing two things. Number one, he made it very clear that the Reserve Bank of India, that is the Indian central bank's main objective, was going to be to fight inflation. And second, he got started off on the right foot almost immediately. On his very first day in office, he announced a set of financial market reforms to liberalize the working of the financial system. And since then, he's continued along that path. Although there have been some glimmers of growth, and although there's been some pressure on him to reduce interest rates in order to boost growth, he's been very firm in his conviction that the way the central bank can best contribute to economic growth is by keeping inflation at a moderate level. And he does seem to be winning the fight against inflation, and he's pushed forward a lot more in terms of financial market reforms, freeing up the banks to operate more freely, liberalizing other parts of the financial system. And another important thing, which the new government of Prime Minister Modi has taken up as well, is to broaden financial inclusion. That is to say, give more of the population access to the formal financial system so that they can better participate in the Indian growth story. So he's been a tremendous boon for the Indian economy.
I would say that America is basically indestructible. Try as the authorities might, they really can't do it in. Goodness knows they have tried. In that respect, it reminds me a little bit of Major League Baseball. You know, America was first into the soup. We have a greater degree of flexibility in our labor markets than certainly than the rigidities on offer in Europe. We are a more dynamic economy in many ways than Europe's and Japan's. We have a more dynamic immigration policy, for example. We have a greater affinity for the enterprise system. So it's not surprising to me that we've done better. However, it seems to me with greater reliance on the price mechanism, with less government interference, with less government manipulation of prices, and I use that term advisedly with respect to financial asset prices, I think we would be a lot better off than we are today. Certainly, we have been better than Europe, but we have not been as good as America has been in times past.
That was our Defining Moments segment. Time now for today's biggest deals. Big deal time with one of my favorite guys around, Mr. Edward Harrison. And today we are talking about some of the biggest deals of 2014. We do this every day on the show, and now we get to go over the really, really big ones. So let's start with falling oil, natural gas, all this stuff. Ed, talk to me. Let's go over this big deal.
Yeah, so we have a lot of time here, so maybe we can develop some of these topics. I think that falling oil, falling natural gas prices, and the strong dollar all come into a nexus together. The way I would kind of look at it from the beginning of the year is that China, at the end of last year, said that they were going to slow down their model, which is export-led, investment-led, and that means that the capital intensity of their model is going to decrease. And therefore, they need commodities less, they need oil less. And oil stayed fairly high, even though they were obviously, decreasing their demand and their growth was slowing. But eventually, oil came down. And I think that, given the fact that the U.S. is doing so well, a strong dollar makes it come down even more in dollar terms. I think all of those things together are going to be a driving force for 2015 in terms of market volatility, because you have all these commodity prices coming down, oil, and now just recently natural gas, which is down 30%. I think that's going to be a big deal in terms of where people were investing their money before all of this occurred.
Absolutely. This will affect a lot of people. You know, because oil was where a lot of people were pouring into, and now you have the strong dollar, which, if you listen to what Rickards was saying for a while, they're all coming crashing down, essentially. Like he obviously just said in the interview that he feels the dollar is strong, and these are just facts, but they came about a different way than I think most people were anticipating. I also want to turn now to the mini crises in many emerging markets, along with the Russia-China $4 billion gas deal. Those are two interesting things to me, and the mini crisis is something to be scared about, because you always talk about kind of that tipping point, right, and how it was Thailand last time we went into a major pullback. So talk to me about this. You never know if it's going to be like that again. You never know, yeah, right, or where it's going to be. So tell me more.
Because think about, 2013, we had the crisis with the taper tantrum people talked about. At the beginning of this year, we had that mini crisis in the so-called Fragile Five. Those were all those countries with, huge current account deficits like Turkey, Indonesia, etc. Now, Russia's in the hot seat, and that's because of oil. So I think that basically the emerging markets thought that they could get away from this trap by building up huge reserves, but there's still the vulnerability, especially when you look at the corporate borrowing, which is being done in dollars, and that's giving, still a huge amount of vulnerability. I think at the same time, however, people are trying to move away from the dollar in some capacity, and the deal that you brought up, I think, is one of the biggest in the emerging markets between Russia and China. And so we're seeing definitely at the same time that you have all this volatility in the emerging markets, that you still have a huge impetus for people to try to move away from the dollar so they can reduce their vulnerability. But both of those things are playing out at the same time. I think 2015 will be a year where you're going to see those things come together.
I agree, and I would like to see what happens with trade agreements in 2015, particularly in emerging markets, because we have all these interesting things going on, and we could get a Tom Hartman on the show who hates trade agreements with a passion, but there is, it's an interesting thing whether it is free trade or anti-free trade, in the sense that why have a trade agreement if you have free trade? But what's going to happen with emerging markets using them and just backing out of the U.S. dollar? That will be fascinating. So I look forward to learning more about that. But now let's talk about Abenomics, the Lammo. Yes. A lot of data out today. Japan not in the greatest spot. What are your thoughts on this? You know much more about this than most people, so I love getting your take.
Well, you were talking about that, I think, at the top of the show.
Of the show, and it's fascinating. They're no longer savers. Japan is just not a saving nation anymore. For the first time on record since 1955, when the Cabinet Office started collecting this data, we learned that the Japanese, they aren't saving. It's dwindling. So
yeah, I think it's a big deal. I mean, what I understand in terms of that, there are two things behind that stat. One is obviously that the demographics are moving towards an older population in Japan, and as a result of that, older people are in a dis-saving mode, and so therefore naturally it puts pressure on the household savings rate. Yeah. But at the same time, you still have the fact that you had all of this this tax coming forward, so people they spend all this money. I would put it at 3 or 4 things. I would say that people are not making money. They're trying to get inflation up without people making more money, and they're taxing people. Do you really expect that to be a successful economic policy? The answer is no.
No, it's not going to work.
It's not going to work.
So now we're at number 4 on our list. We've got to get to all 10. Bond bull market. We have record lows: Germany, Japan, Eurozone periphery, and Switzerland. What's the story with this, Ed?
Yeah, so I think Japan, Germany, and Switzerland, all three, and we may have some charts in them, are good things to look at. Even though the periphery is going down to the all-time lows, I like to look at Japan as a perfect example of people who said, look, you could have invested in Japan 8 years ago and said, no, I don't want to have anything to do with government debt because they're going to blow up and they have too much debt. But as we see, that's not really what's happened at all. We're in a completely different environment, and anyone who gave you that investing advice is really,
giving you bad investing
advice. You as an investor, a domestic Japanese investor who missed out on the huge play in government bonds, you'd be underperforming the market in a big way. Same thing in Switzerland, same thing in Germany. These are the risk-free assets in those particular currency areas, and as a result, what we've seen because of deflation, lowflation, whatever you want to call it, all of these numbers have come way, way down, and it's going to continue.
Absolutely. And if you like 60-40, time to readjust in terms of how you're going to do this. We learned about this with Column. Bitcoin, that's our next one. We talk about this a lot. Love it. We've seen crashing prices, big retailers coming in using it as a payment platform, and some recent reduced volatility. Thoughts on Bitcoin? I love this. I think Bitcoin's the future. I really do.
I can't remember who of our guests in the Bitcoin show said, forget about the, this is like a currency that comes out when it comes out in the beginning. There's a lot of volatility.
Yes.
Forget about that. It's really the adoption rate that matters. And I think that's true.
It's 100% any fiat currency.
And the volatility is coming down. So I think that Bitcoin is something that has staying power, and it will transform in terms of not just being a currency, but also just a payments platform and something that's used for other things.
Couldn't agree with you more. I mean, if you're a gold bug and you're young, you're now a Bitcoin bug for the most part. I just think it's brilliant. There's a lot to be said there. Stagnant wages, that's our next one. We have consumer debt, payday lending, subprime auto, crushing jobs, robots that are all coming out. It's like the Industrial Revolution all over again. That doesn't scare me as much as the robots, but I know it scares a lot of people. So what's this? Wage stagnation or total lack of wage growth? It scares me a lot.
Yeah, so I think all of those things are interconnected. When you have no wage growth, what happens is that to the degree that you can, you build up debt. And, if there's wage growth that's low, the government's obviously pushing down interest rates to get growth, and that allows you to build up debt without having your interest payments going up. So all of these things are coming together to create this so-called low-flation environment, and I think it's going to continue. There's nothing on the horizon that's saying that we're going to get out of low-flation, and so wage growth is going to be a big issue in 2015.
We have 30 seconds, but we got to get to the last one. Negative interest rates. You have Europe all across, Switzerland and Denmark.
Yes. Denmark started it off because Europe was so weak and everyone was going into the Danish krona. Now we see ECB. We also see the Swiss National Bank going into negative interest rates. It's a tax. It also adds to this low-flation environment. All of these things are saying deflation is the thing that you still have to worry about in 2015, not inflation. That's bullish for bonds, and that's going to continue into 2015.
I love it, Ed. We're going to end on that note. Well put. That's all for now and all for us for this year. Thank you for watching, and if you liked anything you saw or you want to drop us a line, go to Facebook, facebook.com/BoomBustRT. And we love to hear from you, so please tweet at us at Aaron8, at EdwardNH. From all of us here at Boom Bust, thank you so much for watching, and we'll see you next time. Bye-bye.